The Fed is expected to start cutting rates this year, and that could mean hundreds of billions of dollars of unrealized losses on low-interest bonds. That's according to a study by the consulting firm Claros Group. Hugh has a new piece out. It's called "Banks Are in Limbo Without a Crucial Lifeline." Let's bring him in right now. Hugh is a CNBC banking reporter. Hugh, this is really concerning to start thinking about what comes next. Why don't you just explain the situation, where these banks are right now?
Hey, good morning. Becky, it's great to be with you. And just to be clear, the Fed cutting the rates is probably going to, on the margins, help out this situation. The issue right now is that, there have been, 10 or 11 interest rate cuts over the past, 2 years or so. And therefore, there are a ton of unrealized losses on banks' held to maturity portfolio in terms of bonds, and also the mortgages that they issued that were all done under a low interest rate regime. And so those are unrealized losses. They're sitting there on the balance sheets. People have forgotten about it because there haven't been, apart from New York Community Bank, any blowups or near blowups. But those are still there, and that's still adding pressure. On top of that, if you screen for the banks in which have the most commercial real estate exposure, something like 300% of commercial real estate exposure versus their capital levels, you have essentially 282 banks that screen for those that have either high CRE, that have also high CRE, and at the same time, compromised capital levels. And so the analysis there is that these are banks, just like New York Community Bank did, that probably need to raise capital, and they probably need to do it within the next year or so. And they can raise that capital through either private equity sources, Becky, or they could try to, link up and get acquired by a stronger bank. Now, the issue there that we know is that last year was actually a 40-year low in terms of bank M&A deal volumes. It was, I think, the lowest since 1990, even before on an inflation-adjusted basis. And so we have a situation, Becky, where you have a lot of banks that are sort of wounded, but they aren't getting the relief that they need.
Hugh, I mean, the reason maybe this has flown beneath the radar screen is these banks are much smaller than New York Community Bank Corp. Yeah. That's the only one with assets above $100 billion. Most of these have $10 billion or less. How big of a problem does that pose to the financial system overall?
Yeah, I mean, I think the good news here is that systematically speaking, each successive round of sort of mini crisis, you think about a year ago with SVB, First Republic, those are above $200 billion in assets. New York Community Bank, a little bit over $100 billion in assets. Now the stress is really moving to the community bank category, and those are between 1 and 10 billion in assets. Those are the great bulk of the institutions that are going to be, facing this stress. Now, there are about 15 or 16 banks that were found in this analysis that were, moderately sized regional banks between 10 and 100 billion. So there are issues there. And as you know, the Federal Reserve Chairman, Jerome Powell, has just candidly said, look, there are going to be bank failures as a result of CRE. It's going to happen. And so, one point of this analysis is to say, look, across the universe of 4,000 banks, where are the issues going to be? And to your point, they are going to be in the middle to small size banks, which is by its nature less systemic. I think the issue is that a lot of these smaller banks support communities, away from the coast. And if they're essentially zombie banks because they're not allowed to raise capital and they're not able to raise capital, they're not able to engage in mergers with stronger competitors, you're essentially, hamstringing the economic development in those communities.
I guess the other question is, the Fed must be aware of this as well. How much pressure does that put on them to cut rates, even while you have an economy that still seems to be booming? And inflation, by the way, that's hotter than has been expected for the last couple of months.
Yeah, so there's this multidimensional issue here in terms of, what outcome are you trying to engineer for? And I don't think that they're going to ultimately say, we're going to, put the cart, before the horse here in terms of what's the priority. And so, you have a cohort of banks out there. They're not the majority of them. They're probably 6 or 7% of all the 4,000 plus banks in the country that are going to run into those issues. You have regulators who are very aware of the situation. They're now on top of it, and they're issuing MRAs and MRBAs, matters requiring board attention to these institutions, and they're sort of confidential, under-the-radar reports saying you got to raise your capital. And that's, I think, their strategy. And they hope to be able to do this. They hope to be able to cajole them into raising capital, to selling some assets to improve their capital situation, and to do so in a way that doesn't cause anything systemic.